Hi, this is Randy Finney with the right side of the chart, and this is a closing market wrap for Monday, March 23rd, 2020. There really, again, as in this same with this morning, not much new to report. Nothing's changed too much technically. There are some things that actually, there's quite a bit to note right now, so it was definitely worth doing a video. But again, we have the Q's closed flat today, 0.05. That's about as flat a close as we've seen in a long, long time. That's technically flat right there, 0.5%. Although we did close down on the S&P 500 and the Dow, everything else. So I'm going to go over. We'll take a look at what was strong and what wasn't today. And let me just give you my thoughts real quick in 30 seconds for those of you that don't have time to listen to the video, want to what I'm thinking, where we go from here. I continue to maintain. I think the risks are actually bilateral. I'm not going to say the risk is skewed to the upside or downside. The risk reward favors being long. The market has continued, at least the Qs have continued to defend the same support level, give or take, for the last week. So, like for the reasons I've cited before, excessive pessimism, short interest, high put to call ratio, high VIX, all those things, it's put a near-term floor, coupled with the fact we're at support, many stocks or sectors at support. But it's not going to stay there forever. And which way we go from here, I think will depend largely, if not exclusively, on the flow of news going forward. To the largest extent, the developments with coronavirus and what impact it's going to have on the economy. We continue to see, a surge in cases, more and more businesses shutting down, or do we get a little abatement there? Maybe some good news on some kind of front, whether it's progress on some kind of combination therapy like I talked about today on the drug, or maybe just hey, we're seeing a lot of people have it, and it's actually not a lot of people walking around with it that didn't have symptoms, and they're going to build antibodies against this, and maybe it's not going to be as bad as everyone thought. I don't know. I'm just throwing out that my thoughts are where we go. I can at times do a pretty good job of predicting where a stock or the market will go based on the charts, on the technicals. Right now, I don't have a strong opinion, and I made that clear on Friday, and I'm going to make it again today. And so, as much as I can use the charts to predict and often where things are going to go, I can't predict the fundamentals. I cannot predict what's going to happen here with the COVID-19, as well as the next steps from the federal government. We're starting to see reduced reaction from the market to everything the Fed's done. I think people collectively are realizing, as it's true that there's only so much the Fed and the federal government and the Federal Reserve can do to prop this market up. The U.S. economy and the global economy is just too big. It is a giant integrated machine, and when that machine stops turning, when you start turning off a lot of switches, again, we haven't seen this. So that's it. So I want to be clear. I say the risks are bilateral. I think they're almost equal. Given the right catalyst for good news, we could rally and finally put a big bear market rally in. Like I said, that could be 15, 20% or more. About that, like I said earlier today, I think about 15% upside off the recent lows on the Qs, and about 20. I think the SPY is likely to outperform on that because there's more beat-down sectors. Again, if we get some kind of catalyst. Likewise, I cannot rule out at all just a drop to the downside to hit these additional, potential targets on QQQ should things get worse. Should we not get any fundamental catalyst? Should we not get an abatement in the bad news? So, if you're wondering, well, Randy, tell me where the market's going to go, I'm not going to do that. I won't force opinions if I don't have a good one. We'll do what I continue to do today. I'll focus on gold, commodities. I'll touch on that real quick. Just tell you that, coffee was up today. Had coffee rallying about, what was it, JO, about... depends on which one I'm looking at. A couple ETFs here, but I'm seeing wheat was up 3.25. DBA, the agriculture ETF, was up. So I'm going to get to those next in the next video. Probably do that one tomorrow. Right now, I want to just say here we are on pretty much on support again. Where did my NQ chart go? Okay, here it is. Same story. Here's that level, about 6,900 or so. Boom, 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 boom. Closed there on Friday after the drop. Went down Sunday night. all the news from the Fed supporting the market, latest steps brought us back up and closed right back on that level. So it's another break and a regain of support. Although this time around, well, we rallied up quick, but we fell back down there. So you can't make anything else of this other than there's that trend line I pointed out earlier today. It was so far the uppermost trend line successfully held and defended. Again, Qs were flat. The S&P 500 was a little weaker, but it did hold that lowermost trend line I gave you this morning on that update, and still has the bullish divergence. It doesn't mean we must rally. Positive divergence is also referred to as bullish divergence, but the potential is there. This is a setup that, given the right catalyst, you could see a big move up in the market. Likewise, the downside catalyst, so I'm going to get to that right now and tell you what I think it could be. The people are almost getting used to the fact that coronavirus isn't getting any better, doesn't seem to be going away anytime soon. The cases are increasing, so I don't foresee a spark, any type of immediate catalyst as far as the coronavirus goes. It's going to drop the market down, but you could see just your market's been holding support. SPY is inching lower. You could just see it break down from a technical perspective. In other words, we've consolidated now about a week, especially in NQ around that level. You could see it drop, but what I think probably the biggest risk to spark another big wave down is this. I'm going to go over the sectors of the S&P 500. In fact, let me pull that up. Hold on one sec. Okay, there's a couple things we're going to look at in this video. We're going to look at what was good in the market today. One day doesn't make a trend. I always caution that. But it was odd to me, the disparity between the S&P 500, especially as I went through the sectors. What surprised me is I keep a watch list of the 11 sectors. These comprise the S&P 500. By far the largest is tech. I haven't seen this in a long, long time. Tech was down 1.36%, and QQQ was almost flat. That doesn't jive. So what I did is I dug down a little deeper, and what was it? Well, it was the semis. You can look here. I sorted these are the 100 stocks within the NASDAQ 100. I'm scrolling down. Percentage changes right here. Here's your symbol. These are all chip stocks. Western Digital, Micro Semi, I believe that is. Not all of them. EA, those are gaming companies. Activision, Take-Two Interactive, EA, Intel. But a lot of chips. ASML, Micron, Applied Materials, chip equipment maker there. So I see a lot of chips up today, and that should be reflected here in the SOX, which is, there it is, up 3.75%. So this was the driver today. And again, that may be a one-day wonder, a technical bounce off support, probably pretty much what it is. Yeah, I did have support here, and I hadn't even pulled this chart since before the video. That was a previous target support. So that was, to me, just a technical bounce, technically induced. In fact, they were oversold at support. Longer term chart still looks bad. All right, so that explains why QQQ was up, especially with the market-leading FANG stocks. That's the thing. That's rare that when you look at QQQ, you don't see this very often. Pull that list back up. Where'd it go? Here it was, right here, QQQ. And now I sort the holdings in QQQ by market cap. So with Microsoft being the largest and Apple, they're $1 trillion companies. Those two were down. Alphabet, Facebook, they were down. 4 of the 5 FANGs, all but Amazon was down. And Amazon, as I mentioned, that's the only stock about a week ago that I picked out as being one of the better looking stocks. It was, rallied over 25% since then. It was at support again because fundamentally they're positioned about as good as, well, obviously as good or better than any of the FANG stocks. They're a beneficiary of this so far. But there it is. Intel was up 8%. Intel's the 6th largest holding in the NASDAQ 100, or has been for a while, probably still is, and that was up 8%. So that's just wanted to show you what was driving the market today. Netflix had a boost. Now let's look at the sectors, because this I think plays into where we might be headed and where the downside risks are. So now when I look at the sectors of the S&P 500, here, let me pull up SPY real quick. SPY, we are on a weekly time frame, and there's we're now well into, as I did the video this morning, halfway between that support zone and this bear market target up right here, the top of the 2015, 2016 highs. And Dow doesn't look any better. In fact, the Dow has already made it there, I believe. The Dow is, has a lot of industrials, and the industrials have gone down. So the Dow has hit that comparable support. And that was a big, big level back then. We broke out, and that was it. The market never looked back. That was almost 2 years of sideways consolidation within that range right there, over 2 years maybe. And we broke out of a very important level. So that is a very important, technically significant level. Hence the reason why, from a technical perspective, charting perspective, when I say technicals, that's talking about the charts, we could bounce. And the Dow, just like the S&P 500 and everything else, had a divergent high back in the leading up. That was the catalyst for that drop back in late 2018. And we continue to push up, only creating a more powerful, larger divergent high. And then when again, the charts, this was all priced into the charts here. I don't track the Dow often, but there it is. And it's just like S&P 500 and everything else. Boom. So there it is. The market is extremely oversold at support, which was, even though I didn't have it in Dow, that it would have been my bear market target, minimum bear market target there, and that's hit in the Dow. So like I said, I've told you guys last Friday, I don't care to be short right now overnight. I'll go in, day trade, off these levels, but I think the risk reward is starting to skew to the upside, especially given that right catalyst. I think there's a potential for an explosive rally. Now, okay, so I started out telling you there could be a catalyst or a downside. What's that? Well, let's look at the sectors within the S&P 500. Starting out with XLK, let's just review these quickly. XLK, tech sector ETF. It burned through the divergence. This is why I say divergences aren't the be-all, end-all. We had just a strong advance. This was dangerous. I talked about it. It was a fewer and fewer stocks carrying the market higher, namely those big top-heavy fangs, Apple, Amazon, Microsoft, Facebook, and they carried it higher. But they're at support right now, or at least the tech sector is at support. Amazon's not in here, by the way. These are just you have the big ones. Most of them are. Microsoft, Apple are in there, and that's it. Facebook is also considered in the XLC, the other new sector that replaced telecom. All right, so that's it, and I don't see the tech sector blowing up. It will come under forced liquidation, forced selling, if everything else. But again, their business models are more sound for what's going on right now. Although a global meltdown of the financial system is going to affect them. Like I said earlier, you're going to buy less iPhones. You're not going to buy that $3,000 Mac. If you're in a recession, you don't have a job, so Apple's going to feel it too. They're just not going to see as much of an impact as, say, Carnival Cruise Lines. XLV, okay, this is the healthcare sector. This is the second largest sector in the S&P 500, and it is at a pretty decent support right there. The same highs, see, back from 2015, 2016, this line here, about 76. They're a little bit below it, and if it takes that level out, goes down there. This is concerning. The healthcare sector is down quite a bit. But the one that really concerns me right here is XLF. So this is what I'm worried about right now. As I've mentioned, being worried about the credit markets more so even than the stock market, as far as the whole global financial system. The credit market sees up. That's not good. And the fact that the banks were down, you can see another. That's a scary number, 666. XLF was down 6.66% today. And again, priced in like everything else, big divergences that have built for years. People, shrug them. I don't think most people incorporate divergences into their trading, but they do often play out. And the bigger they get, the more ominous it is. And now we're back down. You can see XLF is well below the highs from back there in 2015, 2016. And coming up on, I could draw some support lines here, but I'd be forcing them, to be honest with you. There's some pretty good support. Comes in way below here, around 1350. But here's a chart. It's just ugly. I can't, other than extremely oversold, we're not at any kind of solid support right there. And the fact that they are underperforming the market so poorly right now, this is the global marketplace. I mean, yes, tech stocks are where the market cap is, but these are the banks, your world's largest banks: J.P. Morgan, Chase, Bank of America, Wells Fargo, Citibank, even the credit card companies. And this is not a good sign. So where I'm going is, if we get an implosion of a big bank or a very large mutual fund. We already know that the pension funds are they were underfunded before this whole thing started by the tune of about 50% for their future liabilities. Can you only imagine how underfunded they are right now? They have virtually no chance of closing that shortfall anytime in the foreseeable future. And I don't care if they come out with a outright flat cure for coronavirus. There's been so much technical damage. This market would certainly soar, but even to get the financials back to where they were, guess what? You have to rally about 80%. That's the problem with a stock. If a stock falls 50%, you don't have to make 50% to get back to where you were. You have to make 100%. That's how math works. If you're at $10, you drop to $5, you then have to post a 100% return. You have to gain $5 on a $5 share price to get back to where you were. So that's why right now, although XLF has only dropped, I shouldn't say only, it has dropped about 43 whatever percent. I'm just rough grabbing. It's in the pop-up box to the left. Again, to get back to where it was now, you have to post about an 80% return. So that's it, guys. This is what keeps me up at night, not metaphorically, or not literally, I should say, because I'm not going home heavy short the market anymore. That I think I'd milked a good part of what may prove to be the initial leg down. It may prove to be just the beginning of a much larger drop. And I was talking about the stock market as a whole. My proxy shorts primarily focused on QQQ and some semis and things like that. But that's what we need to watch for here. And the market is usually telling us something. There's a lot of smart people out there, and the people that run Wall Street, they know the banks more than anybody. And so if they thought the banks were in okay shape, why are they falling so much? This is, like I said, concerning, and this is what I'm watching for a tell on the really on the global financial system. Here's Berkshire. Berkshire is not a bank per se, but they've got their hands in the cookie jar in 1,000 places: insurance, everything else, real estate. J.P. Morgan Chase, JPM, and again we're on weekly charts here at support, but the next stop is all the way down here at 69.50, and it's starting to crack that 82.20. It's not in a good place technically. It needs a reverse soon, and let that be a momentum-fueled overshoot, or have that prove to be. Otherwise, again, this support level 82.20, we paused there last week, parked right above it, and we're below it now. So there's a stock in a very ugly, precarious and ugly technical posture. And again, that's the world's largest bank, I believe, J.P. Morgan. There's Bank of America at support. So there's one. There's your 2015 highs. Very, very good support. So I do think we'll bounce. And I can tell you right now, if there is a relief rally in the market, and it's legit. Let's say some really good news come in the way of coronavirus, whether it's just an abatement of the cases and whatever it is. Then this sector you might want to jump on, because I think there'll be a sharp recovery rally, even if it's fleeting. And I do these videos because you have to act fast. If that comes. And again, it can go the other way, so don't start seeing dollar signs. And Randy said, we can bounce. He's thinking the market's going to bounce 40%, or the financials are going to bounce 40%. No. I think they could bounce 40% given the right conditions, the right catalysts. And at minimum, we bounce back to that last target there around 22 and change. That's 21% right there on Bank of America. This is Bank of America, of course. And if we bounce all the way up here, that would be my maximum bounce target right now, considering the best possible outcome, big rally in the market. That'd be about a 40% rally. Downside, I don't even want to talk about the downside, because these banks need to hold up soon. If there is a failure, of one of these too big to fail banks, that's the thing. They call these the too big to fail financial institutions. They are too big to fail. The Fed has shot off all its bullets, or just about everything they have. They came into this whole thing with only maybe one or two arrows left in their quiver. They fired those off early. So this is dangerous. I hate to even talk about it. So I have to believe that the banks and the whole market will stabilize soon and bounce, and whatever that catalyst is. I could just be oversold, but if not, if we go down, it's going to get ugly. And then again, I'll probably do a video soon, or maybe some posts on where to put your money, where to park it if you're really worried about financial Armageddon, a complete so far we're just in a pretty nasty bear market, but by all accounts, remember guys, this is the S&P 500 is down what was it, 35% through Friday. I'm just going over these other bank stocks just to show you, because this is a sector I'm concerned about. Wells Fargo has a little more downside here from where they closed today. It's a weekly chart. About 10% downside to a very good support level. Citigroup, not looking good. We had some support here. Just an ugly chart. But going back to this, the S&P 500, just trying to put things in perspective, the stock market could certainly fall more. And maybe the banks fall more and without a blow up. Maybe it's just what's going on. We've only dropped, when I say only, but we've only dropped 35%. Remember the last bear market, the S&P 500 fell about 55%. So I'm trying to just paint the picture that, and just because we dropped 55, that's not the maximum the market can ever drop. The previous bear market was also that, and it was more than that in the NASDAQ 100. So this market could certainly go down a lot more. And so I'm trying to point out catalysts. I don't see much technically. We've already broken support on the S&P 500, so we can continue down to at least that next stop here, that bear market target. And again, that was that same one. It's about 212, a little over 212 from where we closed today. That gives us about another 5% downside. That's very good support. The buyers should step in, quote unquote, should. If they don't, boom, I don't see a whole lot stopping the market. There's some, I can add a minor level there, and I'll do it now. It could come into play, but I'm just pointing out the support levels. All right, so that's it. I wanted to just kind of share my thoughts on, what could spark a rally and where we'd go. More importantly, so you have those numbers ahead of time on the S&P 500. Let me just make that line different color here. Now that's good right there. The S&P 500 bounce targets, well, you had the support zone, but I think all the way up to about that 260 level. Again, given the right catalyst, that's about a 17% pop there. All right, the other sectors in the S&P 500, again, we're on a weekly chart. XLC, communications sector. This one has Alphabet, the Google parent company of Google. It has Facebook in there. And then you have XLY, consumer discretionary. That has Amazon in there. Here's XLY also at it hammered off this support or bounced off the support last week. That's that same high. There's those significant levels back from 2015, 2016 right there. So you have a lot of sectors and stocks hitting that level, including the Dow, which is what I think is in large part putting in at least a temporary floor here. So this is where, if we're going to get a bear market rally soon, this is likely where it's going to come from, either here down to about maybe another 5%, because like I said, the S&P 500 has about 5 more percent till it gets there. But a lot of sectors hitting there. The Dow already hitting that level, those 2015, 2016 highs. And industrials have just been pummeled. They went well below those, but they're at the bottom of that range. Remember, I talked about the top and the bottom. This was what we call a deer market. Most of you are familiar with what a bull market is, and you know what a bear market is. But a deer market is in between, when it's neither of those, when the stock market or a sector moves sideways for an extended period of time. So that was, back here was 2013 when XLI, these are the industrials, one of the 11 sectors of the S&P 500. It entered that same trading range that the market was in, but XLI entered that back in 2013, back here, late summer, early fall, and didn't exit or break out of that trading range until about that time in 2016. So a 1, 2, 3 year trading range right there, sideways trading range. That's why it's very technically significant, and that's the bottom of the range. It was visited quite a few times at that point. So again, from a technical perspective, this is where the market should bounce. Extremely oversold. A lot of sectors at or very near key supports. But if the system breaks, then you don't bounce. And so, like I said, if I had to be one of the two right now, and take a position and lock it away for, let's say, 3 weeks, 4 weeks, I'd go with the long. That's what I'd go with, a long position here. Can I make a strong enough case to go in and add that as an official trade, or to take, my wife's 401k. I have a SEP plan that's self-directed. Her 401k plan, she can't, she can move around in her stock funds or bond funds or cash money market funds, and that's it. So that's, she's in cash because there's really nowhere else to be right now. If you can't short, that is, or go into commodities or things like that. But fortunately, that's why I do these videos. IRA accounts, self-directed IRAs, individual brokerage accounts, and some of you might have 401k plans that offer a commodity fund, and I will get to those tomorrow. So that's it. I just wanted to go over how the sectors look, which ones to watch out for. Keep an eye on those banks. Not good. The lower they go, it is showing you something is really seriously wrong with the financial system, not just the stock market, but the financial system. I mean, the banks are taking it on the chin because, in large part, the energy sector, all these drillers that are going to go bankrupt now with oil, crashing. Guess who's on the hook? Well, bond funds, both LQD. A lot of those will be downgraded. JNK, a lot of the bonds that have been issued to raise money for these drillers are high yield bonds, but they're also loans, and the banks carry a lot of these loans, and they're just not going to get their money back. That's what happens when you loan somebody money. The banks have the same risk you or I do if you loan your friend or neighbor money. And they fall into hard times and they can't pay you back, and that's what happens to the banking system. So economy was chugging along just a couple months ago, and banks were loaning money out. Mortgages, car loans, business loans, and so a lot of those loans are going to go sour, and that's what the market is pricing in the financial sector. It's not just the energy sector loans that are going to be defaulted on. It is everything I just mentioned. And I posted an article about it a while back. It was Wall Street Journal did an article about these car loans. It's just insane how the dealers are convincing people coming in, people that couldn't afford the car they're in now, to default on that payment to turn around and buy a new car so they could get the sale. And there's people that they keep rolling in, turning in a car. They're underwater on that loan, meaning they owe more than the car's worth. Dealerships are glad to get them in a car using creative financing, or sometimes telling them, hey, just stop paying. We'll qualify you first, then stop paying on the other one. That way you get in this first loan before your credit's slammed. All this stuff's going to blow up, and it's starting to blow up here. And so when those people that couldn't afford to buy a car to begin with did buy a car, but they have a job and they were going to make payments for the foreseeable future, everything's fine. So this is what happens when we're seeing the fastest turn ever in history of the economy, going from economic expansion mode, everything firing, to recession mode, and that's why you're seeing this drop. And I think the banks and everyone's trying to figure in how bad is it going to be, how many people are going to stop making car payments, RV payments, mortgage payments. How bad is it going to be for the banks? We know that the government's got their back. They have to. They're all in. They bailed them out back in 2008, and personally I think it's criminal that they allowed them to continue to be too big to fail and expose this risk to the market and the economy. But that's where we're at, guys. So again, I'm not trying to sound doom and gloom, but don't underestimate what impact it could be if one or more, and it's probably a cascading effect. If one of the too big to fail banks fail, it probably wouldn't just be one. And there might be a lot of smaller regional banks too, and those can add up. So that's where we're at, guys. I don't know where we go from here. I can make the case that we're at support on a lot of sectors in the markets, and we should bounce. I hope we bounce. And I think, again, it's going to be the flow of the news headlines, the fundamentals over the next couple weeks, even the next few days here, will likely dictate where the market goes. So I think if we go much lower than 5% to the downside, we could start snowballing and the risks go up for an even bigger, an outright crash, if you don't want to call this a crash already, which you probably could at this point. All right, I'll end it here, get this video out to you guys, and we'll pick it up tomorrow. Like I said, I can't give anybody individual investment advice, but my preference is to keep things light right now for every reason I said. That even if there's another 10-20% downside in this market, I'm fine not catching every bit of it, because bulls make money, bears make money, pigs get slaughtered, and so I'd kind of step back a little bit And I'm kind of more interested in catching the next pop when I start to see some positive news flow and some positive technical developments. Again, everything that I talked about going back to the beginning, these downtrend lines on the 60-minute charts of both NQ, ES, this is NQ right here. See these uptrend line holds, see a breakout above last Friday's highs. That would be technically bullish. That could also trigger a catalyst. And by the way, you might not, the news headlines will usually follow. So if you see the market break out first and you're wondering why is the market going up so much, don't be surprised if shortly after that the headline follows some positive headline, whatever it is. Again, whether it's directly related to coronavirus or not, same thing. Here's your trend lines on the S&P 500. This is QQQ. Trend line right there. We had a slight pop over it, but SPY is still below trend as well. So these are the things that could fuel the catalyst. And again, the divergences are in place. So this is the way I'm leaning towards, as I was last week. And again, we got those bounces. We had 10% bounces last week. I think we could see this week or in the next coming week here 15% or more given the right conditions. That's it. All right, we'll wrap it up here, and I'll pick it up tomorrow. This has been Randy Finney with Right Side of the Chart. Have a great evening.